The smart money always moves first. While newspapers trumpet prosperity and politicians promise endless growth, a select few are already heading for the exits. They see the cracks before they become canyons. They smell the smoke before the fire consumes everything. And in the final hours before disaster strikes, they act with precision while everyone else sleeps through the alarm. October 28th and 29th, 1929 were no different. As millions of Americans dreamed of riches that would never come, the real players were making moves that would define the next decade. The question isn't whether the crash was coming. The question is what the insiders knew when they knew it, and what they did about it while ordinary investors were still buying the dream. The Roaring Twenties had intoxicated America like no decade before. Stock prices doubled, then tripled. Radio companies, automobile manufacturers, and consumer goods firms saw their shares rocket skyward month after month. Ordinary Americans who had never owned stocks before were borrowing money to buy them. Taxi drivers gave stock tips. Shoeshine boys discussed market trends. Everyone believed the party would last forever. But beneath the euphoria, a handful of seasoned investors were watching different signals entirely. Joseph Kennedy, patriarch of what would become America's most famous political dynasty, was already positioning himself for catastrophe months before it arrived. While the masses celebrated record highs, Kennedy had quietly begun selling his holdings throughout 1929. The story goes that he decided to exit the market after his shoeshine boy started giving him stock advice, but the reality was more calculated. Kennedy understood leverage better than most. He knew that when everyone borrows to buy stocks, the system becomes a house of cards. One strong wind, and everything collapses. By late October, Kennedy was not just out of the market, he was betting against it. Bernard Baruch, the legendary financier who had advised presidents and made fortunes in previous panics, had also been reducing his positions throughout the summer of 1929. Baruch had lived through the panic of 1907. He knew the warning signs. When speculation reaches fever pitch, when borrowed money floods the market, when everyone believes prices can only go up, that is precisely when they prepare to fall. Baruch later wrote that he could sense the danger in the very air of Wall Street, the conversations, the confidence, the reckless optimism. It all reminded him of previous crashes. By October, Baruch had converted most of his portfolio to cash and government bonds. He was ready for the storm. But it was not just individual investors who sensed trouble. The Federal Reserve, America's central bank, had been tightening credit throughout 1929, trying to cool what they saw as dangerous speculation. Interest rates climbed from 5% to 6%. The message was clear to those paying attention. Easy money was ending. When central banks stop feeding the bubble begins to die. Yet most investors ignored these signals. They were too drunk on profits to notice the bartender cutting them off. European money had also begun fleeing American markets weeks before the crash. Foreign investors, particularly the British, had watched American stock prices climb to levels that defied logic. They knew that what goes up beyond reason must eventually come down with equal violence. British banks quietly liquidated their American holdings throughout September and October. When the crash came, their money was already safely across the Atlantic. The signs were everywhere for those who knew how to read them. Margin calls had been increasing for weeks. When investors borrow money to buy stocks, they face margin calls if prices drop. The broker demands more cash or threatens to sell the stocks. As early as mid-October, margin calls were flooding brokerage houses. Smart money saw this as a red flag. If people were already struggling to meet their obligations during good times, what would happen when times turned bad? The answer was obvious to anyone who had lived through previous panics. Trading volumes had also been climbing to unprecedented levels throughout October. On the surface, this looked like enthusiasm. In reality, it was desperation. Heavy volume often signals that large players are distributing their holdings to smaller investors. The professionals sell to amateurs who still believe the story. It is the classic pattern of every bubble. The insiders get out while the outsiders pile in. October 1929 was no exception. Even the companies themselves were giving signals to those who cared to look. Corporate insiders had been selling their own stock in record quantities throughout the year. When the people who run companies start dumping shares, it suggests they know something the public does not. These were not isolated sales. They were systematic liquidations. The smart money inside corporations was heading for the exits just as surely as the smart money outside. Jesse Livermore, perhaps the greatest speculator of his era, had been positioning for disaster since early 1929. Livermore understood crowd psychology better than almost anyone alive. He had made fortunes in previous panics by betting against the consensus. As 1929 progressed, Livermore built enormous short positions. He was not just avoiding the crash, he was preparing to profit from it. When stocks fell, his bets against them would pay off magnificently. By late October, Livermore was ready for the killing of a lifetime. The bond market had been sending warning signals for months. When stock prices soar, bond prices usually fall as investors abandon safe assets for risky ones. But in late 1929, bonds began to strengthen even as stocks climbed higher. This divergence confused many observers. In reality, it showed that sophisticated investors were quietly moving money from speculation to safety. They were preparing for trouble even as the headlines celebrated prosperity. International currency movements also hinted at coming chaos. The dollar had been strong throughout the 1920s, attracting foreign investment to American markets. But by autumn 1929, subtle shifts suggested that confidence was wavering. Central banks in Europe began accumulating gold instead of dollars. It was a quiet vote of no confidence in American financial stability. When central banks lose faith, private investors usually follow. Perhaps most tellingly, the very structure of the market had become dangerously unstable. By 1929, nearly 40% of stock purchases were made with borrowed money. Investment trusts, the 1920s version of mutual funds, were borrowing money to buy stocks in other investment trusts that were also borrowing money. It was leverage upon leverage upon leverage, a pyramid of debt supporting inflated prices. The smart money understood that when everyone owes money and prices start to fall, the selling becomes unstoppable. Forced liquidation feeds on itself until the entire structure collapses. The professionals had seen this pattern before in other markets, other bubbles, other crashes. They knew that financial gravity always reasserts itself eventually. What goes up without underlying value must come down. The only question was timing, and by late October 1929, the timing was becoming clear. The smart money was not just getting out, it was positioning to profit from the disaster they knew was coming. While newspaper headlines still proclaimed the dawn of a new era of permanent prosperity, the real players were making very different calculations. They understood that markets are cyclical, that bubbles always burst, that leverage always demands payment. They had studied history, and history was about to repeat itself with devastating precision. The crash was not a surprise to them. It was an inevitability they had been preparing for all along. The hours before the crash were filled with frantic phone calls, hurried meetings, and desperate attempts to salvage what could still be saved. But for those who had been watching the warning signs, October 28th was not about panic. It was about execution. They had spent months preparing their strategies, and now it was time to implement them with surgical precision. On the morning of October 28th, trading opened with heavy selling pressure. The Dow Jones Industrial Average had already fallen significantly in the previous week, but most investors still believed it was merely a correction in an otherwise unstoppable bull market. The smart money knew better. They recognized this as the beginning of the avalanche they had been anticipating. While amateur investors held their positions hoping for a recovery, the professionals were accelerating their exit strategies. Jesse Livermore was particularly active during these crucial hours. He had been building short positions for months, but on October 28th, he dramatically increased his bets against the market. Livermore understood that once panic selling begins, it feeds on itself. Margin calls force investors to sell stocks to raise cash. Those forced sales drive prices lower, triggering more margin calls, creating more forced selling. It becomes a vicious cycle that destroys everything in its path. Livermore positioned himself to profit from every step of this downward spiral. The telephone lines between Wall Street and the great estates of Long Island were burning with activity. Wealthy families who had made their fortunes in previous decades were liquidating positions they had held for years. These were not speculative trades. These were generational wealth preservation moves. The old money families understood something that newer investors had forgotten. Markets can take away decades of gains in a matter of days. Better to sell too early than too late. European investors were also making their final moves on October 28th. British and German banks that still held American securities were dumping them at any price. They had watched the American bubble inflate beyond all reason, and they wanted no part of the inevitable collapse. The transatlantic cables carried a steady stream of sell orders from London, Paris, and Berlin. Foreign money was fleeing America as fast as the communication systems of 1929 would allow. Corporate executives were facing their own moment of truth. Many had been granted stock options as part of their compensation packages. These options were worth millions on paper, but only if they could be exercised and sold before the crash destroyed their value. Throughout October 28th, company insiders were converting their paper wealth into cash at a frantic pace. They knew their own businesses better than anyone, and they could see the storm clouds gathering over the entire economy. The Federal Reserve was also taking action, though their moves were more subtle. Central bank officials had been meeting in emergency sessions throughout October, discussing how to respond to the growing instability. Some argued for lowering interest rates to support the market. Others insisted that the speculation had to be purged from the system, regardless of the short-term pain. While they debated, the smart money was not waiting for government intervention. They were implementing their own solutions. Bernard Baruch spent October 28th making phone calls to his network of contacts across the financial industry. Baruch had survived multiple market crashes by maintaining relationships with insiders who shared information during critical moments. These conversations confirmed what he already suspected. The selling pressure was not coming from small investors getting scared. It was coming from institutions, banks, and wealthy individuals who had decided that the party was over. When the big players move in unison, resistance becomes impossible. The commodity markets were also flashing warning signals that the smart money was reading carefully. Gold prices had been rising steadily throughout October, suggesting that investors were seeking safe havens. Oil prices were weakening as traders anticipated reduced industrial demand. Agricultural products were under pressure as farmers worried about their ability to secure credit for the next planting season. These moves in commodity markets often precede stock market crashes by days or weeks. The professionals were connecting the dots while amateur investors remained focused only on stock prices. Investment trusts, the mutual funds of the 1920s, were facing their own crisis of confidence. Many of these trusts had borrowed money to amplify their returns during the bull market. Now, as prices began to fall, they were receiving margin calls from their lenders. The trust managers faced an impossible choice. They could either raise cash by selling their best holdings, or they could default on their loans and face bankruptcy. Either choice would accelerate the market's decline. The smart money understood this dynamic and was positioning accordingly. Banking stocks were among the first to show serious weakness on October 28th. Professional investors knew that banks were heavily exposed to stock market loans. If the market collapsed, many banks would face devastating losses from loans that could never be repaid. The early selling in banking stocks was not random. It was informed speculation by people who understood how financial systems interconnect during times of stress.